it's the expectation for founders, for startup companies. They want more from their investors than just a check. They want advice. They want mentorship. They want you help to help them access individuals or people or companies or help them build relationships.
Hello and welcome to Wealthion. I'm your host, Andrew Brill. We have exciting news. On June 1st, we'll be hosting a conference in conjunction with SALT. Look for more information coming out very soon. And many of us look at investing and automatically just think about the stock market. Private equity is another avenue to make investments and is more within reach than you think. I'd like to welcome Carrington Carter to Wealthion. He's a former brand manager in the pharmaceutical industry, but is now an entrepreneur, wealth strategist, real estate developer, and the co-founder of East Chop Capital. Carrington, thanks for joining me and welcome to Wealthion.
Andrew, it's a pleasure. Thanks for the invitation.
So tell us a little bit about yourself. I know that you're in what we call the private equity markets, but not really, because you're into wealth building and all that. So tell us a little bit about yourself.
Sure. Fantastic question. So I am a private equity and venture capital investor. We started the private equity firm East Chop Capital about 5 years ago. I would say ever since freshman year in college, I've kind of been obsessed more or less on this wealth building journey, understanding that while money doesn't solve all problems, it certainly helps make the world a better place and improve one's quality of life. So I've been a student of investing and building wealth over the last 20 years or so. And I found a way to do that through private investing in the private markets and also in the public markets.
So you found this passion of yours when you were in college. What was your first project where you were like, okay, you know what? I'm going to give this a shot.
Yeah, I would say, during the Great Recession is where I kind of scratched my teeth in real estate. I mentioned college, so I read Rich Dad Poor Dad, Robert T. Kiyosaki, popular book among all in the industry. But I cut my teeth on real estate during the Great Recession. I started investing in neighborhoods that I knew in and out in my hometown of Dayton, Ohio. And I watched property values, quadruple or quintuple over a short amount of period of time. So that's how I kind of scratched my teeth in the real estate market and just continued to build upon my career that way.
Was there trepidation, anxiety about, oh, you know what, I'm going to do this and this could fail miserably?
Yeah, there was, and I had you mentioned in the intro a previous career in pharmaceutical marketing and advertising. So I had a good job kind of in corporate America. But when the Great Recession hit, I saw a lot of people lose their job or couldn't get a job. Kind of much like the layoffs that you're hearing, consistently in the headlines here today. So I thought, how can I kind of take control of my own destiny? So yes, there was some fears, some trepidation. I think I bought my first property in 2012, whereas the recession hit in 2009. So it took about 3 years to kind of get over those fears and those jitters. But once I committed, it hasn't been smooth sailing since then. But I've certainly have become better equipped to deal with the undulations of the market.
Do you remember the first property you bought?
Absolutely. We closed August 14th, 2012 in Dayton, Ohio. It was a 4-bed, 2.5 bath, about 1,900 square feet. And we sold it. I can't remember when we sold it. I believe maybe 2019 or so.
So you do buy and sell. Is that the kind of the trick to this? Is you buy sort of when it's low, you watch certain areas? How does that all work?
Yeah. It kind of depends. We have a kind of a diversified portfolio strategy and under various entities, we own different real estate assets and also other private equity and venture capital investments. So, some we have, long-term holds, some traditional single family, multifamily, some we're about a pipeline of about 50 million in real estate development projects that we're excited about. And I'm actually now in one of our luxury vacation homes here in sunny Orlando, Florida. We're checking in on some of our construction projects. We're doing about $10 million in new construction here in Orlando in Reunion Resort, 10 minutes south of Disney and about 25 minutes south of Universal. So to answer your question, our strategy kind of depends on the particular property, the location, and kind of what's our long-term outlook for that asset.
So you might get a chance to go and visit the mouse while you're
Absolutely,
in Orlando.
absolutely.
So How would somebody, if they're thinking, you know what, I'm going to do what Carrington did, but I need to start with my first property. How do you evaluate that? How do you make sure you don't lose your shirt?
Yep. I think first, make sure that you're familiar with the market. Do your research. I often tell people be a student of the game, understand macro and microeconomic trends as it relates to real estate. What are the population drivers or the attractions to the area? Is it Disney or the new employers coming to the area, or the warm climates? So just kind of understand kind of the macro and the micro. Myself personally, when I buy or invest in real estate, I invest in real estate that I would want to live in, or that I would want to use, or that I would want to visit. There are many different strategies out there, but that's kind of one of the ones that we employ. Finance real estate is very capital intensive, so you want to make sure that you have good financing partners, and it often takes a long time to develop a deep, meaningful relationship with banks and other lenders. So that should also come into factor how much you can afford, whether with yourself or whether with your investors. And we have about 200 investors under our East Chop Capital network, and we've done great things with them and continue to keep growing with them and providing strong returns.
Carrington, do interest rates play a part in this? I obviously they're lower than I guess the average. I mean, we've seen mortgage rates 7-8%, even higher than that in some cases. Right now they're in that 7 range. Does that matter when you're going to purchase one of these properties, whether you're going to flip it, try and fix it up and flip it, or if you're going to try and rent it out and make some money?
They do play a factor. I think more than anything, they make you higher interest rates force you to buy right, to make sure that you're buying at the right price point, and you're not afraid to walk away from the deal if the numbers don't work. I think higher interest rates also force you to be a better operator. When money was cheap and rates were low, then most deals kind of made sense. But again, higher interest rates force you to be more disciplined with your buying, with your operating, and certainly with your exit.
Now, one of the services that you provide at East Chop Capital and through yourself is wealth strategy and consulting. Would real estate be part of that on how to build wealth?
Real estate is a part of that. Real estate is a part of that. And I would say, we say at East Top Capital, our commitment is to provide the best combined financial, educational, and social returns. So with any investment, financial returns are obviously the expectation, but we are equally as passionate about educational returns and social returns. Make sure people know what they're buying, why they're buying, what is your strategy as it relates to that investment, and then the social returns. We enjoy bringing people together, networking, building relationships. So we do that with annual investor retreat. We do that with receptions in various cities across the country. So yes, helping people build wealth over time is the core of what we believe in, and we help people do.
So buying a property, you said, in college you had this itch to build wealth and start maybe in real estate. It doesn't happen overnight. How does somebody learn the right way to do this?
Yeah, I think a lot of learning is by doing. I mentioned earlier, be a student of the game. So there's certainly reading that you can do. There are podcasts like this that you can listen to, but nothing beats actually cutting your teeth, getting your hands dirty, buying your property, taking your bumps and bruises, becoming a part of networking groups and talking and communicating amongst your peers. I think those are key components that help people be successful in the long run. Um, Real estate is a long game, and recently we've been saying it has gotten longer. So I know people often see on HGTV and a lot of these TV shows, and certainly on social media, Instagram, Facebook, fixing and flipping. It's difficult. It's always been difficult, and it's certainly a lot more difficult with rising interest rates, with material costs and other costs that have gone up quite a bit. So real estate is a long game, and it's gotten longer.
But it's not without its bumps and bruises. Like you said, if you're just going to say, okay, you know what, I'm going to go into this and I'm going to give it a shot, you have to be prepared to readjust on the fly or try and figure things out that aren't going exactly right.
Exactly, and that's part of the strategies that we've employed with our more traditional real estate, also with our luxury vacation rental homes. So under our East Chop Capital private equity firm, we've had 2 real estate funds. Our first fund we launched in 2018. That's on track to do about 25% returns net of fees. Our second fund we just closed last quarter, and so that fund is off to the races and doing quite well. And I'm down here in Florida now, monitoring some of those new construction projects for that fund. But as far as pivoting and kind of adjusting, it's important to have a pulse on different markets, or if you're looking at one market, then different areas within that one market to make sure that you're having kind of a diversified approach to building out your real estate portfolio.
So vacation rentals can also, it obviously the best if you're going to own a rental, you want to have it rented out. But vacation rentals can be lucrative as well. As you said, you're sitting in one of your vacation rentals that can be lucrative as well, even if it's not rented 100% of the time.
Correct. And so when we started as single families, it's also obviously the traditional 12-month lease. But one of the reasons why we want to pivot to vacation rentals on a short-term basis, a weekend, extended weekend, or a week or even longer, is the ability to adjust pricing based on demand. And so that gives you added flexibility versus kind of the long-term rentals. So, and with that flexibility, you don't necessarily need 100% occupancy. And we tend to focus on kind of the larger houses, the 5 to 12 bedroom houses. Typically, there's less competition in that segment. And there are a lot of different ways that different types of groups can use these homes.
And do you, when you go into a project, like you say, you're overseeing some projects in Orlando now, do you buy land, or is it something that you've purchased that you're going to knock down and rebuild?
Yep. Andrew, great question. And this kind of goes to the pivot strategy earlier. So when interest rates were low and when there was less competition in the market, you could typically find a house, maybe do some renovations, and it would be a strong performer. But because rates were low and a lot more people got into this space, we decided to pivot, buy land at favorable prices with cash, and then work with builders who have a strong reputation for building high-end custom luxury homes, and then try to realize some economies of scale by building multiple houses with the same builder. So even during COVID, where there was still some uncertainty, we absolutely came in and bought land at favorable prices, and we know we'd eventually build on those plots of land.
Are there major challenges to what you do, and how do you overcome those challenges?
Yeah, I would say it first starts with having a strong team, and we have a strong team with East Shop Capital, and obviously our local partners on the ground, either our builders and contractors or our property management companies who help us manage the house and with the maintenance of the homes and also deal with our guests. So it starts with having a strong team. And then with any entrepreneurial type endeavor or any business, a lot of it's about resilience. It's about grit. It's about hard work and sticking to it. And then be willing to pivot and adjust based on whatever market dynamics are happening at the time.
But East Shop Capital isn't just, okay, we're going to build this. You'll take in investors. Let's say I wanted to invest in something and I just wasn't quite sure. I could come to someone like you and say, you know what? I have some money put away and I'd like to invest. You would take that money and give me the opportunity to invest in a certain project, right?
That's correct. So with our first two funds, our first fund is doing well. Our second fund is doing well. Those funds are closed. We will actually launch several funds in the future. And we also have isolated real estate projects that we do seek investments for. It just kind of depends on our deals and our opportunities at the time. And then, kind of going back to what I mentioned in college and understanding this concept of having your money work for you and not just working for your money. Real estate is a big component of what we do. But we also angel invest in a variety of industries, understanding that, especially with technology and other investments, those are also in part of building kind of a diversified wealth building portfolio. And we invite our investors to join some of those investments with us. As a matter of fact, I would say so far this year, we've closed about 6 deals outside of real estate, ranging from fintech to insurtech, invested in a professional sports team, a hotel hospitality fund we've invested in, a Starbucks licensee we've invested in. So industry agnostic is kind of our mantra or our strategy. It just kind of depends on the appetite for different deals at the time.
You also own part of a whiskey company, a very, very quick growing whiskey company.
Absolutely, absolutely. Uncle Nearest Premium Whiskey. It's one of the fastest growing, most awarded uh, spirits of all time that recently crossed the $1 billion valuation mark. The CEO, Fawn Weaver, is just outstanding and continues to do amazing things with that company, with that product, and then different or different product extensions off of the whiskey. So absolutely, we are the largest, actually minority-led group in Uncle Nearest Inc., and we're excited. We're proud of that.
Explain to some of our viewers that may not understand what exactly is angel investing.
Sure. Angel investing. I would say, when any company, when they're starting out, when they're a startup, whether it's a tech company or whether it's a restaurant or even, like a t-shirt manufacturer, angel investing is more or less going in first. You're that friends, family, or sometimes they say fools round. So you're the friends or family round of financing. Because when a company is a startup, they typically can't get traditional bank financing. So they're relying on friends, family. They're relying on angels and in most cases credit cards. So you're a part of kind of that group who is helping this company mature and grow. So that's what angel investing is. The check size or your investment could be anywhere from $1,000 up to 100,000 or 250,000. It just kind of depends on your strength as an investor and your financial security, your appetite for risk, and how confident you are investing in this particular opportunity.
So they can. So if back to the original investors, so me or our viewers, we could come to you and say, you know what, we want to put some money in your fund, and we're going to let you invest it the way you see fit in an angel investing sort of environment.
Yeah, that's how we did with our real estate funds. We haven't launched a fund for angel investments yet, but what we have done is we invest through what's called SPVs or special purpose vehicles, or they can also be known as syndications. And that's just a fancy term where you create a legal entity, typically an LLC. You pool capital from investors, and then you make that particular investment. So when I gave the example of the 6 investments we just made, ranging from 2 fintechs to a hotel fund to a Starbucks licensee, we've also invested in venture capital funds. So with all of those investment examples, we created an entity, a special purpose vehicle. We collected investors' money, and then we made that investment into the company. And then obviously we report to investors on a quarterly basis or an annual basis to let them know how their investment is doing. As a matter of fact, there's this Riverside platform. We're actually investors in this platform through a venture capital fund that we invested in back in 2022. So investing in funds is a good way to get diversified exposure to different investments. So when we invested 300,000 in this venture fund, we have exposure to about, I think, 25 different companies within that fund.
I appreciate you investing in Riverside. I really like this platform. It's one of my favorites because it's got a lot of tools that I like to use, teleprompter and all this stuff. So I thank you for helping to get this off the ground. Now, how does someone realize a gain? If say, okay, you know what, I'm going to invest. And you, like you said, you can invest anywhere from $1,000 up to $250,000. How does someone realize a gain on that money?
It depends on the particular investment, and that's part of the reason why we like real estate. Real estate, it has cash flow. They're cash flowing properties, so a lot of times you can realize gains that way through distributions or from the sale of assets. On the angel investing side or the venture side, often gains are only realized when the companies are either acquired or when they go public. So those are typically the ways that you realize gains in this kind of investment world. And that's why we couple real estate investments with kind of angel investing, because you can realize gains in a lot of different ways. With our first fund, I mentioned we're on track to do about 25% returns net of fees. Part of those gains have been the 8% preferred dividend from the cash flow of the properties. And the other part of the gains have been when we sold the properties and they've appreciated over time.
So how do you go in and say, or how do you evaluate a company and say, you know what? Yeah, I think that this is a good place to put some money.
Yep. On the company side or on the venture side, first we look at the market opportunity. How large is the market? It is $1 billion market. Is it 100 billion? And the thinking there is if it's a large enough market and this company can capture a certain portion of it, then the investment will likely do well. So we look at the market size. We also look at the industry, not just the market. Is it growing? Is it shrinking? Is it stagnant? Who are the major players in the industry? Michael Porter, Harvard professor, has this kind of the five forces model of a market. What's the competition like? What is the buyer? Is there buyer power? Is there supplier power? So we kind of look at the dynamics of the market. Also, probably most importantly, is the team. Who's the founder? Who's the leadership team? If it's a tech company, who's their CTO? How are they as leaders? How are they as people? Do they have the ability to mobilize people behind an idea? There's a saying, angel investing is more. It's more important to bet on the jockey than the horse. So who's the jockey is kind of most important in this game, and that's one of the other factors that we take into consideration as we evaluate a company. And I'll say lastly, how much more capital will this company need to scale, and do they have the ability to continue to raise capital if that's needed in order to scale? Because if you invest early stage and you don't think this company or the founders will be able to raise more money, then it's almost, flushing money down the toilet to invest early if you don't think they're going to be able to continue to scale.
So I was once a sports broadcaster, and I covered horse racing. And yes, betting on the jockey, I had some of my favorites, so I did that a lot. But the team is important. The team that you have to have confidence in that team that's trying to borrow money and get this company off the ground.
Yep, absolutely.
How much money do people actually come looking for?
I would say it varies based on kind of the stage of the company. So usually, I'm going to take a step back just to, depending on the experience level of your viewers. So with fundraising and angel investing realm, there's early stage, which is considered pre-seed investing or seed investing or Series A. And then the series kind of go B, C, D, E, F, all the way through the rest of the alphabet. And so you typically raise small amounts of money early, 500,000, 1 million, 3 million. And then as your company grows, your capital needs are greater. So you raise more money kind of in the out years of your capital raise. So that's typically kind of how it goes.
How do you find out about these things? Obviously, they're not just advertising, hey, I need money and I have this great company and here's my prospectus or whatever it is that they're going to show you. How do you find out about this? I would assume that because you've done this before, somehow you have an inside track. But if I say I have a lot of money sitting around and I want to put it to work, how would someone find out about this stuff?
Yeah, so there's no shortage of companies out there raising capital. I think part of it is being a student of the game and getting involved. There are platforms like Kickstarter and WeFunder and things like that where companies are looking to raise capital. Angel List, that's another platform where people can go and sign up and get what's called deal flow. That's when deals are emailed to them. There are also tech incubators and probably most cities across the country, especially large cities. I live in Columbus, Ohio. There's a tech community there where there are companies and angel groups that are connected to these companies looking to raise capital. Not too long ago, I was down in Tulsa at a business incubator out there called Act House, and they had a demo day. Demo day is basically when companies go through an incubation period. It could be anywhere from, 5 weeks up to 20 weeks, where they're gaining skills and mentorship and resources to help scale their company. And then demo day is kind of like the graduation, where they unveil their product. They pitch to investors. So there are demo days all across the country. There are pitch competitions. I think a lot of professional organizations now typically incorporate some kind of a pitch competition as a part of the conference or as a part of the week's activities. So I would say, actively look for deals and opportunities, and you'll start to be more aware that there are available.
Pitch competition sounds like a little bit like Shark Tank,
Absolutely.
but on a different scale.
Absolutely. And Andrew, one other thing that might be helpful to mention, angel investing is governed by the SEC, the Securities and Exchange Commission. And there are 3 important criteria levels that investors must meet in order to invest. The lowest threshold is called an accredited investor. In order to be an accredited investor, as an individual, you have to have 200,000 in household income. As a married couple, 300,000 in annual household income, or a $1 million net worth, excluding your primary residence. So that's kind of the minimum threshold for angel investing. The step above that is you have to be a qualified client, and that's 2.2 million in net worth, I believe. And then the highest threshold in order to participate in a lot of venture capital funds is $5 million in assets, and I'm sorry, $5 million in investments, and that's a qualified purchaser. So those are just kind of the high level criteria in order to angel invest.
Is there a time frame when you angel invest to hopefully get your money out of that investment?
Yeah, well, it depends. With a lot of things, it kind of depends on the product or service, the industry, the company, and then also where you invest in them along their time frame. So, example, if you're investing early at the early stage, pre-seed or seed, you're going to be with them for a long ride. It could be 5 years, 8 years, 10 years, or even longer. But if you're coming maybe Series C, D, or E, somewhere along there, and they're going to IPO soon, or is a higher probability that they'll be acquired, your timeline to invest might be shorter. So that's kind of on the investing side, the angel side. But on the real estate side, I mentioned, real estate's a long game and it's gotten longer. So with real estate, I would think of it more as a 10, 20, or maybe even a generational play, depending on the investment, and think of it as something you can pass down to your posterities, to your kids, to your nieces, nephews, and those that come after you to help them build wealth.
But on the real estate side, there is some income generated. On the angel investing side, is there some income generated as well?
It depends on the investment. If it's a high growth tech company, then often not, because they're plowing their earnings back into the company to fuel their growth. I mean, if you think about companies, even like Apple, Apple was a publicly traded company for many, many years, maybe even decades before they even issued a dividend. But since they're in the public market, you can trade their stocks, so you can lock in some gains that way. Amazon is another company, high growth tech company. I don't believe that they've issued a dividend. So different type of investment, but just kind of put that into perspective that often investing is it's a long game.
Yeah, one of them just declared a dividend. I'm not sure which one it is, but it's like for the very first time they did. So it's that is on the horizon. Now, how closely do you get to monitor progress with your angel investments?
Yeah. I would say it depends on the investment, but for the most part, the companies that we've invested in, the founders that we've invested in, it's a very close relationship, and they're an open book. So it's as simple as just reaching out to them and having a close look on their progress. I would say, with the advent of technology, most of them kind of have in their communications cadence, either an email going out monthly or quarterly to keep investors aware of the particular investment. We do the same with our real estate investments. We're sending out quarterly updates to our investors. We have annual investor retreats where people can come live and interact with us. And we're also on the road quite a bit. And whenever we're in a city where an investor lives, we certainly try to connect with him or her whenever we have that opportunity.
Does anyone come to you and say, you know what, this is your expertise. We'd like to have you be an angel investor, but we want you a little more involved than you would ordinarily would be, because this is what you know.
Yes, they have. They have, and I would even venture to say that now, it's the expectation for founders, for startup companies. They want more from their investors than just a check. They want advice. They want mentorship. They want you to help them access individuals or people or companies, or help them build relationships. So I would say I'd also have a saying: money is the cheapest form of currency. Cutting a check to an investor, or I'm sorry, cutting a check to a startup or to a company, that's kind of the least you can do. There's so much more required to build a business, and they're leaning on their investors to help them with those other resources.
And I would assume everyone has an idea, and there's no such thing as a bad idea if you bandy it about and figure out if it's a good, if it can work or not. But as an investor, you'd love to have your ideas heard, I would assume.
That's correct. That's correct. It's also important when you're evaluating a founder or a leadership team for their minds to be malleable, for them to be open minded and receptive to feedback. So that's a characteristic that you want to look for. But then also, I'm an investor. I'm also an operator. I've operated businesses, and I still continue to build businesses. And so as an investor, you need to recognize that they're the best person to run their business typically at that time. So it's about trusting them to do what they think is best, and even if they make mistakes, to pivot, to adjust, and then to move the business in a different direction.
Now, part of your business is wealth consulting and strategy. What advice would you give to a young person starting out, as you were at one point, that is looking to enter the private equity market?
Yep. I would say, be a student of the game, read, listen to podcasts, get your hands dirty, be able to be willing to roll up your sleeves. And I would say, teamwork makes the dream work. I think key to our success has been working together. Myself, my general partner, Calvin Butch Jr., who's located in South Jersey. We've been building East Chop for the last 5 years. We've been investing together for almost 15 years. So work together. And then also, I would say, I'm big on setting goals and writing them down, reviewing them quarterly, biannually, yearly, and being committed to that growth as an individual and then also as a team.
Looking back, anything that you wish you knew before you got into this?
That's a great question. What I wish I knew, I would say, I think often we put limits on ourselves, either because of fear or because of a lack of confidence. So I would say, anything is possible with the right team and with the right persistence, determination, and grit. We've grown up in a time where we've seen, phenomenal companies have been built over the last couple of decades, whether it's Tesla, whether it's Apple, whether it's Amazon, whether it's OpenAI and ChatGPT, just NVIDIA with artificial intelligence chips. We've seen miracles happen with building these companies, and I think it's been possible because you have visionary leaders at the helm who have dared to dream big. One of our went to Hampton University undergrad. Our college professor was Dr. William R. Harvey. He had this saying, dream no small dream. So if you can conceive something in your mind and you're willing to put in the hard work, then anything is really possible, and I believe that.
You say you have to be willing to adjust and do the hard work. Is there a challenge that you can remember that you had to overcome, whether it be in an investment or a project, that you said, wow, maybe this just wasn't worth it, but in the end you were able to work through it?
Andrew, that's a big question. I mean, I would say every project. No project goes as planned. No investment goes as planned. So it's always monitoring, evaluating, pivoting, and adjusting, having those difficult conversations, and try to figure out what you can do better. And so there is. This might not be helpful. There's nothing that stands out, but I would say everything. Everything has been a challenge. It's not easy. Everything requires refining your strategy. So yeah, building, and I would say over the last, with the advent of social media, I think founders, business owners, private equity fund managers, VC people are being a lot more honest and transparent about just how difficult it is to build businesses and do great things. So I'll say everything is hard. Everything is hard.
As a little kid, Carrington, is this what you envisioned you would be doing when you were, a young kid on the playground?
Absolutely not. Absolutely not. And that's where pivoting comes to play. So I studied chemistry in undergrad, did my MBA in marketing. I actually wanted to be an interventional radiologist. So I was going to study chemistry and then go to medical school. But I took a break after grad school and went to business school. I fell in love with business, and I realized you can make a lot more money, or you can make as much money in business, and you can have a greater impact on the world and the economy without the student loans and without an additional 10 years of school. So I decided to pivot into business. And then even with private equity, it's just been, our journey has been a testament to setting goals, being resilient, and working to build the life that you want to have. Myself or my partner, we didn't work on Wall Street. We both went to top 25 business schools, but we didn't go to the Whartons or Harvards or whatnot. But we're still in private equity. We're still in venture. We're investing in funds. We're shaping the next generation of founders and entrepreneurs. So no, I had no idea this is the life that I was going to build, but I'm grateful for it and I'm having fun.
And your partners, were you friendly with them, or are these people you met in college?
Yep. We went to college together, so we both went to Hampton University. I was a freshman when Calvin was a senior, so we were there at the same time, but didn't know each other. We connected an alumni event at an alumni conference. So that's another piece of advice I would give to anyone, especially the young folks. Tap into your alumni network. Go to those, join your local chapter, go to those annual alumni conferences or those regional conferences and connect with folks because you already have that commonality. You already have those same principles and values that your university instilled in you, and you can use those to foster into even deeper relationships and have success that way.
So to sum up, Carrington, it sounds like the best thing to do is just go and do it.
Yep.
Learn, be prepared, and just try and learn everything about what you're about to do.
Yep. Absolutely.
And the money will definitely, be there if you do it the right way, and seek help. You know what? Call up Carrington and say, look, you know what? Can you give me some advice? Use your services to get that going.
Absolutely. And then Andrew, I'll add one thing to that, and it's fresh on my mind because I'm reading Simon Sinek's book, Start With Why. So I think it's always important to kind of have that to center you. Think about why you're doing X, Y, and Z, why you're making this investment, why you want to build this business, or why you want to create this team of people around you. So always asking your question, why, and being grounded in that, I think also will result in you creating the life that you want to build, and then doing it with the people you want to do it with.
So, Carrington, I want to thank you so much. This was enlightening. I think that if there's people out there that want to invest in real estate or get into private equity, they can now realize you don't need $1 million. You can start with 1,000. You can, if you have a lot more, obviously you can spend a lot more. But thank you so much. This was eye-opening for me, and I think that our viewers will find it very, very helpful. Thank you for joining me.
It's been a pleasure.
Where can we find you, either on social media, or if somebody wanted to reach out, where would they find you?
Sure. So East Chop Capital, we are on LinkedIn. We're also on Instagram and Facebook. So feel free to reach out there. I'm on LinkedIn as well, Carrington M. Carter. And then mention our luxury vacation rental homes. So we actually market those under a separate brand called Getaway Society. And you'll see our portfolio there, which spans 7 states. So we're excited about the growth of that, especially our new construction projects coming online. And then that's at Getaway Society on Instagram, and then getawaysociety.com, and then eastchopcapital.com. We're everywhere. And then if you can't find those, then Google. Good old fashioned Google, you can catch us.
Yep, use the Google machine. Carrington, thanks so much for joining us. I really appreciate it.
Thank you, Andrew. It's been a pleasure. Have a good one.
That's a wrap on another discussion here on Wealthion. Thank you for joining us. If you need help being financially resilient, please head over to wealthion.com, sign up for a free, no obligation consultation with one of our registered investment advisors. And remember to follow us on social media, please, for the latest news and information to help you invest wisely. And if you could like and subscribe to the channel, we would greatly appreciate it. Don't forget, hit the notification bell so you can find out when we post new videos to the channel. Thanks again for watching, and until next time, stay informed, be empowered, and may your investments flourish.